Welcome everyone to the IntentGen Financial Capital Markets Update, Spring 2023. Purpose of this call today is to update you on the capital markets. That's the wording for each of the asset classes that typically represent your portfolios. See what's happened thus far this year in the markets, some of the reasons behind why we've seen some of the trends, some of the trends that we see going forward, and then really how does that impact our view going forward in 2023 and beyond. With me today, I have my colleague, Pat Morris. Pat Morris, most of you have met or talked to at this point, but for those who have not, he is our investment manager and also a chartered financial analyst. And we continue to be so excited about the depth of knowledge that he's able to provide us as advisors and support, and then also to you as clients of ours. And so Pat's going to be really diving into some of the intricacies of the markets and updating us on each of those asset classes, as well as some of the macroeconomic themes that we're seeing this far. Now, we don't have, I'm a partner at the firm, Jacob Schatz. We don't have an attorney with us or legal or compliance on this call today, but we are obligated to show our disclosure slide, just highlighting some of the key components of this presentation. Now let's look back at our themes to start the year. We all remember early on when we sent these out, we were looking at three high-level themes. And first was persistent volatility. That was not just taking the volatility of 2022 and applying it to 2023, but looking at historical market levels and the return to normalcy in terms of market volatility, and that materially higher interest rates were leading to greater volatility of some of the individual asset classes. So we see that trend really in 2023 continuing, and then even beyond. Moderating inflation was another theme of ours. Not just solving inflation, we can't just distinguish it, but we think we see a path towards moderating and hopefully the continued trend downwards from last July where we saw the high. And the last one was bear market bottom. So we don't know if that was already behind of us or still to come, but really preparing portfolios to prepare for better years ahead and potential capturing of upside. And how do we diversify holdings to weather any portfolio storms or volatility, but also put us in a good position going forward? Now I'm going to pass it off to Pat. He's going to talk about some of the asset classes in the hot start in 2023 and go from there. So I'll let you take it away here, Pat.
Right. Thanks, Jacob. Yeah, 2023 is off to a much better start than 2022. In front of us, we have the returns of the three major, we'll call them asset classes for 2023 and for April. So April was a positive month. The dark blue bars there you'll see will be fixed income, the gray bars are equities, and the light blue bars are real assets. So rates were kind of range bound in April. So you see that most of the fixed income was positive. You got a better return on high yield and longer duration, a little bit of the riskier assets, which carry higher coupons. So that's where that performance came from. We'll dive deeper into the value and growth, but basically continued good performance in large cap and international developed. Small cap saw a negative return. A lot of that had to do with some lagging technology stocks and a little bit in the smaller cap financials. And then emerging markets had a negative month, and a lot of that was due to consumer discretionary sector and also China. On the real asset side, we saw slightly positive returns. U.S. equities continue, or real estate equities continue to do okay.
And Pat, I said I wouldn't interrupt you or ask you any questions until the end, but as I'm reviewing or looking at this chart, I think there were two things that stick out to me. One is the international developed returns year to date versus large cap. And I'm reflecting on what that looked like in 2022 And then also the commodities, if that was specifically related to energy or what's really driving that downward trend, at least for this year. Any
Yeah. Yeah, the commodities, I'll dive into it a little bit later, but the commodity return negative 6.1%. A lot of that has to do with energy. And that was pretty much for two reasons. One, an economic slowdown, there's less demand for oil. And the second one was a kind of a bigger overriding theme to why international development has done so well, in that there was a much warmer winter in Europe. So this, I think before the winter came to be, there was a lot of angst over where they were going to get their oil, where they get their natural gas, especially with the situation in Russia. But since that turned out to be better, commodity prices, especially energy prices, have gone lower.
Thank you.
Okay. Here we go. Went too fast. Let me get this for you. Okay. The mouse is acting a little bit funky here. Here we go. Okay, so the fixed income market update. The U.S. Treasury curve, as we see there, went from the long end, the 10-year bond, went from 388 down to where it was at the end of April to 345. So, but that wasn't a straight path down. It went from 388 down to 330, up to 407, and then finally settling down where it was. So it doesn't seem like it wasn't a straight path down. The continued volatility, like we spoke about as one of the themes, and you can see the yield curve continues to be inverted. Now, one of the things that's kind of contradicting that is usually in an economic downturn, you'll see an inverted yield curve, and a corresponding move will be that there is a greater spread between what the treasuries and what corporate bonds do. And in this case, we'll talk about high yield bonds. So usually high yield bonds, as you can see down at the bottom chart, the 10-year historical average for high yield bonds is 400 basis points, or 4% above what the treasuries are paying. In times of economic uncertainty, that can go up to 8 to 9% above, but we're not seeing that. We're seeing it's above the 10-year average, but not much, and it's not really even at 5%. So just something to for thought. This next chart, and I apologize for the busyness beforehand, but this is the probability of where the Fed funds rate will be on December 31st. So you can make investments based on this at the Chicago Mercantile Exchange. So, but basically what we're looking at is at the beginning of the year, people thought by the end of December 2023, we would be at 450 to 475 basis points, kind of where the year began. But in January and February, we got some robust economic news, and people thought, whoa, the Fed's not done. They have more work to do. So it climbed all the way up to 550 to 575 as you see in the yellow. Then we had a little bit of a banking scare or banking problems, and people pivoted the other way. And then it went down to 375 to 400, finally kind of settling almost back where it was at the beginning of the quarter. What does this mean? And we've seen another rate change in May. So right now we're at 500 to 525, or 5% to 5.25%. So what does this mean? Well, again, it's more persistent volatility, but we believe that we're closer to the end than we are the beginning of the Fed rate hike. And that's good clarity for the market, and that's a good thing.
Mm-hmm.
The next slide is this talking about moderating inflation. And as Jacob pointed out, inflation peaked in the summer last year at 9%. It is moving down to 6%. So, but one of the things about these numbers are, it's a 12-month number. So a lot of the stickiness that happened at the beginning of last year is still in the numbers. So we, along with our research partners at Fiducian, kind of ran something, was a 6-month number, and to see what that would be like. And, obviously more volatile because it's going to change more, but you can see the 6-month number annualized is now at 3.2%. So another portion of it is, and we talked about this at the beginning of the year, is that one of the biggest components of CPI is shelter. And one of the biggest components of shelter is something called owner's equivalent rent. And it's kind of a really sticky number. So that portion has not been going down, although we have seen, the Case-Shiller, Zillow, Redfin, a lot of these places showing lower home prices, but those numbers haven't started to reflect into the CPI. So what does that mean? Well, we don't think inflation is going to be at 2% anytime soon, but we do believe it's on the right path. And that, again, is very important for the market. So I'll run through, we went through some of the equity market updates, but just kind of go through and show you, this is April, which we went through before, but just real briefly, large cap beat small cap in the US. Value outperformed growth, that was kind of the first time, I think this year that it did, and we'll touch on that in a minute. In the developed markets, pretty much the same thing, although at a little lesser pace. Large cap was just barely above small cap, and value outperformed growth. Emerging markets was a different story. Small caps did better than large caps, but value was still the way to go. So if we look at the domestic equity index returns, what does this tell us? Well, as you can see there, growth has beaten value in the large cap, 15.5% to 2.5%. And in the small cap, growth is 4.8% versus a negative for the value for year to date. So large is beating small, and growth is beating value, although value beat growth last month. Where are these sector returns? What are the big sectors? Well, information technology, communication services, and consumer discretionary are the three that outpaced the S&P and added a lot. That's a lot of the weight, as you see there in parentheses. Information technology is 26% of the S&P 500. So those three kind of drove the performance. Next, we'll look at the international developed and then the emerging markets. So kind of the same story in international developed, a very strong year. International developed is outpacing the S&P 500. Growth beat value, not as much as it did in the US. There's about a 5% difference here. And same thing, large beats small, but not as much as it has in the US. So the emerging markets is a little bit of a different story. Small caps have outperformed large caps for the year, and but value has beaten growth. So different story. Out of the largest developed markets, the G10, 6 of the countries beat the United States. The only 3 being Belgium, Canada, and Japan were slightly under. But those 6 that beat all have double-digit returns for the first quarter of the year, or for year to date through April 30th. Emerging markets, like we said before, China has had a bad year to date so far, minus 1%, and China is a large portion of the emerging markets.
Yeah, maybe before you jump to the US dollar, and just a highlight that I saw here, again, going back to 2022, I think if you look at some of the worst performing asset classes or spaces, those right now, at least through the year, are some of your highlights. And so it really reinforces that whole concept of one is, when things are bad, revisit your plan and don't sell out, because if you sell out, you sometimes lose out then on part of the recovery on these asset classes. And then also number 2 is diversification really matters. That goes in not just the style, but then also, as we're seeing it from a higher level, US to international to even emerging markets, is things move in different directions at different times, and you don't always know when those things are going to shift or move differently. And that's really why it reinforces that diversified holding approach.
Yeah, that's a great point. One of the things that, that comes into focus and why international stocks were doing so well or anything, the US, this is the US dollar index. So the dollar index is down, and that is good for foreign investment. So anything that is a non-US dollar based has done well. Now, is this going to continue? we don't know, but at the very least, we think it won't be the headwind that international markets have been running into for what has been pretty much the last 10 years. So what we're talking about, diversification, and this slide I thought was pretty interesting. It's almost like looking into a reflecting pond, but this is the performance of certain growth stocks in 2022 and how they did the first quarter of 2023. So you've heard me refer to them before as people refer to them as FANG, Facebook, Apple, Amazon, Netflix, Google. And they all had bad 2022s, but they've kind of rebounded here in 2023. So and the next slide will even show, this is a heat map of the S&P 500. I'm not usually a big fan of heat maps, but this case, I think this is a pretty interesting. The larger the box, the larger the percentage it is of the S&P 500. So you could see some of those big boxes had positive returns: Apple, Microsoft, Meta, Google, Tesla. So that's, do we think this is going to continue? Well, typically, higher interest rates are bad for growth stocks because growth stocks are going to have future earnings, and those future earnings are now discounted because of a higher interest rate. But, is it, go next slide here. So here's the, the PE for the NASDAQ 100. So this 10-year historical average is 21.7%. We're approaching 26%. So has it gotten overheated? Could be. Do we think it's possible that the 10 stocks that kind of drove them returns for the last 10 years do it again? Well, it's possible, but not probable. When we, advocate a diversified portfolio like Jacob was just talking about, you don't know when the growth stocks are going to come in or the value stocks, are large or small. So a diversified portfolio is always the key. So one of the things one of the focuses on was pivoting from what the Fed did in 2022 to the effect the Fed was going to have in 2023. So, and was rightfully so, 2022 was the year of the Fed, but now we're trying to focus on what does that mean? What does it mean towards earnings? What does it mean towards businesses? And quite frankly, going into 2023 at the beginning, analysts had somewhat of a still rosy picture for the earnings. I mean, they were calling for earnings to be down 0.3%, which, is relatively flat. And what we'd like to see is, kind of a lowering of earning expectations, because that allows for an easier companies to beat and surprise on the upside of their earnings. And that's a good foothold for, a bear market bottom. And that's in case exactly what happened. By the end of the quarter, people were thinking, or analysts were thinking, that their earnings were going to be down 6.6%. And it turns out with 92%, I just checked the other day, 92% of the companies reporting, it's 2.5, it's down 2.5%. So we have seen a lot of earnings expectations lowered, and we've seen companies beat those earning expectations, which is a good thing for a bear market bottom. That's the best quarter since the fourth quarter of 2021. So up until 3/31, it had been 267 days since earnings peaked on July 8th. And typically, or I would say on average, 230 days from earnings peak to trough. So does that mean that we're at the trough? No, what it means is that we're further along in the bear market bottom. And we don't have, the power of an all clear bell to when to get back in. And typically, earnings will, the markets will peak 3 months before earnings, or markets rebound 3 months before earnings trough. Real quick, as we talked about earlier, the real market, real assets market update. Energy, as we saw, we're down. We went through that and kind of explained where that came from. Some of it, the economic slowdown, some of it a better than anticipated winter in Europe. Precious metals were up. Usually when there's times of uncertainty, gold comes into play. So precious metals were up slightly. On the REIT sector, this was a kind of an interesting one. Most of them are positive. I mean, diversified now is slightly negative, retail is slightly negative. Obviously, the big drawdown you see down there at the bottom is office space, down 16%. The statistic was at its peak, hybrid working was 60% of the workforce. That number has dropped to 30%. So it's gone down quite a bit. Pre-COVID, that number was 4%. So obviously we're not, I don't think we'll be back to 4%, but we have a lot of ways to go from 30% down to 4%. So what does this all mean? So our changes at the beginning of the year that we made, that we went through, we kind of increased US bonds, the core bond portfolio, took some away from dynamic bonds. Dynamic bonds did really well in 2022. We shifted that to core because we think that they're going to carry a higher interest or higher coupon rate. So that's where we made that move. Moved a slight move from high yield bonds from global bonds. And we moved a slight bit from US large cap to US small cap. And we believe in the long term that that's a good move. We didn't do any changes to international developed or emerging markets, although we're slightly overweight in those compared to the index. And real assets and alternatives, nothing really moved there. So with that, I'll hand it back over to Jacob.
Yeah, thank you. A lot of great data that you went through and information, and seemed to be a much different environment from what we were experiencing last year. But certainly, I would highlight, going back to the beginning of the conversation, the persistent volatility, moderating inflation, and bear market bottom, that those themes are going to continue to be drivers in the markets this year, and perhaps even beyond. I think that's an important key of those market outlook or those market themes, is they're not just here's what it is January 1 through December 31st, that sometimes you'll see continuance of those as they impact portfolios, they impact the decisions that we make. And so I appreciate you, Pat, going through some of those changes that we did back in January as we review our 10-year market outlook. And that's just looking at what we might expect from return and risk of each of the asset classes. And based off of that information, that really molds then the decisions and the percentages that we have in each of these pieces represented on the screen here. Now, our committee, along with our research partners, internally meets consistently each month. We review this information, we rerun our data, we look to see if there are changes that need to be made. So it's not a preset date on the calendar that we need to say, by this date we need to make portfolio changes, but it is preset that we are meeting regularly to review these, to make sure that we've got you in the best investments that we have access to, and that you've got a diversified portfolio that doesn't just have the next month in view, but really the next year and beyond in scope as well. So we want to make sure that we are getting you as much information that's topical and relevant. Also know that we are having a watchful eye on things, and that if there are at any point things that pop up or come up that we need to be in touch about, and we will make sure to communicate that. And so do expect a little bit more information out of us here over the next month or so. Pat, before we close, maybe you can highlight on it, but certainly a conversation that we're having with a lot of clients right now is the debt ceiling. So you're starting to see that on a lot of the headlines. You're starting to see a lot of perhaps panic, but perhaps, Pat, you can highlight what steps we will be doing, obviously as a team ahead of time, but then also maybe just high level as a client, what should you be thinking about in terms of your actual portfolio?
Sure. Well, there has been a lot of news coming out this past week, I think, before the president went overseas to talk about the debt ceiling, and the negotiations are going on, and they seem to be going fairly well, considering the kind of contradiction points of the Republicans and Democrats. But there's always going to be, issues that are going to move the markets, whether it's banking or, in this case, the debt ceiling. This has been, I think since 2011, there's been numerous times that this debt ceiling issue has come up. They either, suspend the debt ceiling or raise it to a new higher number. But As far as what it means for portfolios, we are not changing our view. We think most investors should not alter their portfolios based on the debt ceiling and remain focused on their long-term and rely on their asset allocation.
Very good. Thank you. And we will certainly continue to keep up communication as it comes through us and our team as well. But if you do have any questions today, please don't hesitate to reach out to myself, Pat, or your dedicated advisor or planning coordinator that works with you closely. We appreciate the time that you took to watch this and join us virtually, and look forward to seeing you all again soon.